All right, before I get to your calls about what the Fed needs to do here, let me just ask you this. Has the Fed lost the thread here in that we have people coming on and saying, well, now after the Fed's pivot, inflation is still 8.5%, and the market is pricing in cuts. You have one Fed official after another coming on and saying, we're going to stay tight for a while here. Is the Fed lost the narrative here, Bill?
Well, I think the market's misunderstanding what the Fed is up to. The market's taking the notion that they're going to slow down the rate of tightening to imply that the peak in rates is going to be lower and the Fed's going to cut rates in 2023. I think the Fed's going to be higher for longer than what market participants understand at this point. And I think basically people misread the last Powell press conference. They took the notion that we might not get 75 basis points in September as implying that the Federal Reserve is almost done. I don't think the Federal Reserve is almost done. They know that they have to do quite a bit more to push the unemployment rate up to generate additional slack in the U.S. economy. And if you look at underlying inflation measures like the trimmed CPI, trimmed PC deflator, and the median CPI, those underlying inflation measures are running in the 4 to 6% range. So there's a lot of work to do. Even if energy prices come off and bring down the headline rate of inflation, the Fed's got a lot more to do.
Bill, why don't you give us your idea of how much more the Federal Reserve has to do? We have Fed officials, I think Jim Bullard is talking about going to 4.4. Even Charlie Evans, these are people you have worked with for many years, is talking about 3.75% to 4%. Is that sort of the range where you think the Fed needs to go, or do you think it needs to go higher?
Well, I think it depends on how financial markets react to the Federal Reserve's tightening. As Powell said, the economy runs on financial conditions, not just short-term interest rates. So if the markets are buoyant, then the Federal Reserve has to do more. I think 4% plus is the minimum that I'm expecting. I think the other thing that's important to recognize here is the Fed's not going to ease off anytime soon because they need to be confident that they're actually getting inflation back down to 2%. The mistake of the 1970s was not that Chairman Burns didn't tighten monetary policy. He did tighten monetary policy, and he actually generated a couple of recessions. But he didn't stay tight enough for long enough, and so inflation got embedded. Inflation expectations rose, and then that's what required Paul Volcker to come in and really put the economy through the ringer. And Chair Powell doesn't want to do that. So they want to be highly confident that they've solved the problem of inflation before they relent.
But, Bill, the Fed is not winning that argument. When you look at the rate outlook as priced in the futures market, guys, if you have that Fed rate outlook chart, I don't know if you got it done, but the end of next year, the market is pricing in rate cuts, which tells you that, and I started thinking about this, the Fed's message is not symmetric. It said, we're not even thinking about tightening, but it hasn't said we're not thinking about loosening. So the Fed has been, on the one hand, very strong about easing policy, but not that strong about staying tight. And I also think, Bill, when the market has it wrong, it's sort of the Fed's fault. The Fed has to be responsible for that. What's your view on that?
Well, I think the problem here is that the market doesn't believe Powell when he says he wants to get inflation back down to 2%. They think basically if inflation is 3%, middle of next year, and the economy is soft, the Fed will relent. I think that's the key question. I believe that Powell means what he says, but it's going to take time for the market to understand that.
Bill, one of the challenges, I'm sure, for Fed officials in trying to convey this message is that if we go back 1 year and see what Fed officials were sincerely saying about how rates were likely to stay lower for longer. Maybe we'll have one hike this year. I mean, conditions change, and the market might just be reacting to the anticipated change in what inflation might do, or, inflation could come down the hard way through a recession or the easy way through, statistical good luck and just the Fed's actions already in place. So I just wonder how you would navigate it in that role right now, aside from what is happening already, which is Fed officials saying that nothing much has changed about their current framework.
I think the important thing here is if you were willing to ignore transitory inflation on the way up, you need to ignore transitory inflation on the way down. So if the headline inflation rate comes down sharply because of the decline in, say, energy prices, you really want to look through that in terms of what's going on beneath the surface. Let's look at wages, for example. The wage trend seems to be about 5 to 6%. That is not consistent with 2% inflation. Why are wages rising so fast? Because inflation is high and because the labor market's really tight. The key issue here is the tightness of the labor market. The labor market is much tighter than the Federal Reserve wanted it to be. expected it to be. The ratio of unfilled jobs to unemployed workers is 1.8 to 1. It was in February 2020, when the labor market was also very tight. The ratio was 1.2 to 1. So the labor market is much tighter than the Fed wants. The wage inflation rate is too high, not consistent with 2% inflation. That's why the Federal Reserve has to navigate this, generate a slowdown that lasts long enough to push the unemployment rate up well above 4%.
Shepard Smith here. Thanks for watching CNBC on YouTube.